Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. In Part 2 of Buyout Funds Explained, we'll explore the risks involved and the key reasons investors choose these funds despite the challenges. Access to exclusive deals. Buyout funds unlock opportunities off-limits to regular investors. When Blackstone buys a chain of warehouses or Carlyle takes a SaaS company private, those deals aren't available on the stock exchange. Here's why exclusivity matters. Pre-IPO growth stages. Funds buy into companies before they hit public markets, capturing early-stage upside. Think of Airbnb's private valuation jumps before its IPO. Custom deal structures. Buyout funds negotiate terms like earnouts or seller financing that retail investors can't access. Direct value creation. Unlike passive shareholders, fund managers can replace underperforming CEOs or shift business models overnight. How buyout funds stack up against other private equity. Not all private equity is equal. Compared to venture capital or growth equity, buyout funds offer lower risk. They target stable cash-flowing businesses, not unproven startups. Faster returns. Exits typically happen in 3 to 7 years versus VC's 10-plus year horizon. Predictability. Mature companies have historical data for accurate valuation, unlike speculative tech unicorns. That said, buyouts require larger minimum investments and longer lockup periods than REITs or hedge funds. The trade-off. Potentially higher rewards for those who can wait. Whether you're looking for diversification, stability, or above-market returns, buyout funds provide tools most investments can't match. The key is picking managers with proven track records, because in private equity, execution is everything. Risks and challenges of buyout funds. Buyout funds promise strong returns, but they come with real risks. High fees, long lockup periods, and external shocks can erode profits or even lead to losses. Understanding these risks helps investors make smarter decisions. Regulatory and economic risks. Changes in laws or a shaky economy can derail even the best buyout deals. Governments might tighten lending rules, tax policies, or labor laws, squeezing a fund's ability to operate. For example, interest rate hikes. Buyouts rely heavily on cheap debt. When rates rise, borrowing costs jump, cutting into profits. The 2008 crash showed how quickly over-leveraged deals can collapse. Recessions. During downturns, portfolio companies earn less, making debt harder to repay. Bain Capital's 2008 buyout of Clear Channel faced defaults when ad revenue plummeted. New regulations. Stricter antitrust laws or environmental rules can limit exit options. A fund planning to sell a company might face delays or forced divestitures. Mitigation starts with stress testing deals. Top funds model scenarios like rate spikes or slumping sales before investing. Diversifying across industries and regions also helps spread risk. Illiquidity and long lock-ups. Buyout funds tie up capital for years. Unlike stocks, you can't sell your stake quickly if you need cash. Most funds require a 10-plus year commitment, with early exits costing hefty penalties. To cope, investors should treat buyout allocations as permanent capital, balance them with liquid assets like ETFs or bonds. High fees that eat returns. Buyout funds charge 2 types of fees. Management fees, 1 to 2% of assets yearly. Performance fees, 15 to 20% of profits. Over a decade, fees can swallow 25% of your gains. Vanguard's S&P 500 ETF, by contrast, costs just 0.03% annually. Smart investors negotiate fee caps or invest through platforms like iCapital, which pools smaller commitments for better terms. Market volatility and timing risk. Even great companies can flop if bought at the wrong time. Paying too much during a market peak leaves little room for error. The 2007 buyout boom saw firms overpay for targets, leading to losses when the financial crisis hit. Funds that bought tech firms in 2021 faced write-downs as valuations later crashed. Patient capital helps. The best funds avoid bidding wars and wait for sensible prices. Look for managers who walk away from overpriced deals. Operational missteps. Not every turnaround succeeds. A fund might misjudge a CEO, fail to cut costs, or bet on the wrong growth strategy. J. Crew's 2011 buyout by TPG and Leonard Green floundered after expanding too fast into weak markets. Sears collapsed under Eddie Lampert's hedge fund ownership after stripping assets without reinvesting. Investigate a fund's hands-on experience. Teams with deep industry expertise tend to spot pitfalls earlier. How to invest in buyout funds. Investing in buyout funds isn't as simple as buying stocks. It requires careful planning, deep research, and a clear understanding of the process. You'll need to evaluate funds, meet investment minimums, and pick managers who align with your goals. Let's break down the steps. Due diligence checklist. Before committing capital, scrutinize the fund's track record and strategy. Here's what to look for. Performance history. Check the fund's past returns, but dig deeper. Look for consistency across market cycles, not just standout years. Avoid funds with one lucky hit. Team experience. How many deals has the GP completed? A team with 20-plus years in the industry will handle downturns better than newcomers. Fund strategy. Some focus on specific sectors like healthcare or tech. Others buy distressed assets. Make sure their approach matches your risk tolerance. Fee structure. High fees kill returns. Compare management fees, typically 1–2%, and carried interest, usually 20%. Avoid funds charging both on unrealized gains. LP-GP alignment. The best managers invest their own money alongside LPs. Skin in the game means they're motivated to perform. Exit track record. How many successful exits has the fund had? A 70% plus success rate is solid at debt usage. Over-leveraging can sink deals. Ask how much debt they typically use and how they stress test repayments. Spend time reviewing the fund's marketing materials and audited financials. Talk to other LPs if possible. Minimum investment requirements. Buyout funds aren't for small wallets. Most require $250,000 to $5 million minimums for direct investments, $50,000 to $250,000 if investing through a feeder fund or platform like iCapital. Some funds lower minimums for talent, employees of the firm, strategic partners, repeat investors. If you can't meet the threshold, consider private equity ETFs or publicly traded PE firms like Blackstone or KKR. They offer exposure without the lockup. Choosing the right fund manager. Not all GPs are equal. The right one can mean the difference between tripling your money and losing it. Look for the transparency. Managers who openly discuss failures, not just wins. Sector expertise. A team that knows manufacturing inside out shouldn't suddenly pivot to biotech. Operational focus. Avoid financial engineers who rely only on debt. The best fix broken businesses, stable team. High turnover is a red flag. Core leadership should stay for decades. Avoid first-time funds. Even experienced GPs struggle launching their own fund. Overpromising. Returns above 30% annualized are unrealistic. Steady 15 to 20% is more credible. Ask for references from past LPs. A good manager won't hesitate to provide them. Getting started. Ready to invest. Follow these steps. Find fund opportunities. Use platforms like CAIS or PitchBook, or work with a private wealth advisor. Review documents. Study the Private Placement Memorandum, PPM, and Limited Partnership Agreement, LPA. Commit capital. Wire funds to the escrow account. Most funds call capital over 3 to 5 years, not all at once. Monitor performance. Expect quarterly reports. Track IR and MOIC, multiple on invested capital. Patience is key. Unlike stocks, you won't see daily price updates. The real test is the exit. Buyout funds offer a compelling path for investors seeking high returns outside traditional markets. They combine operational expertise with financial leverage, targeting undervalued companies for restructuring and profitable exits. The potential rewards are clear: double-digit annual returns, portfolio diversification, and access to exclusive deals. But these benefits come with risks, from heavy reliance on debt to long lockup periods and high fees. Before jumping in, consult a financial advisor to assess whether buyout funds fit your goals and risk tolerance. The right fund manager can make all the difference, so focus on due diligence and track records over hype. For more insights on private equity and alternative investments, subscribe to stay updated. Ready to explore further? Start by reviewing top-performing funds or connect with an advisor who specializes in private markets. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.